advance it a little bit. It's interesting. Yeah, 10 o'clock. Somebody ought to be chiming in about now. Today is the 27th. Okay. Hey, Peg. Yeah. It's nearly time for the class to start and no one has chimed in.
Is your email okay? Did you double check it?
Yeah. Yeah. There we go. Good morning, guys.
Good morning.
We're getting down to the final stretch here.
Yes, sir.
My watch must be off a tad. What time do you guys have?
9:59.
Okay. Yeah, I'm a couple of minutes fast. Good morning, guys.
Good morning, Mr. Codd.
Guys, I've got 10 o'clock. I guess I'll start. One of the things I wanted to do with you today is to go over one more problem, specifically the Lose Corporation, which I believe for you is slide, now that's interesting. Okay. Oh, that's really weird. Okay. Huh. Well, you have your slides, right? Slide 24 has the Lose Corporation. I really don't know what is going on with PowerPoint today. Let me try one more time. The show is not working. All right. Well, I'll write this stuff up then. Luz Corporation. And I believe this is on slides 24 and 25. It's just another problem to work, dealing with project cash flows. They've got equipment that costs $2 million. They're thinking about a project where they'll have to purchase $2 million worth of equipment. The depreciation percentages for year one, it's 33.33%. Year two, 44.45%. And something I would give you on the test, even though the project won't be kept that long. Year three would be 14.81%, and year four, 7.41%. This equipment will be depreciated according to this schedule, except they're going to sell the equipment and shut down the project. After 2 years, with a projected salvage value in year two of $500,000, they believe this project will contribute to sales in the amount of $3 million per year. And cash operating costs in the amount of $1 million per year. And again, this will be a 2-year project. They're going to shut it down after 2 years. And let's see, what else do we need? Tax rates 40%. And our job is to figure out what are the cash flows for this project? What is the initial cash outlay? What are the operating cash flows for years 1 and 2? What is the terminal cash flow for year 2? So, well, I always put my solutions in red, so I'll put them in red. Oh, and I did leave one other thing out. Yeah. They had a working capital investment required for the project of $50,000 for inventories. And they expect to recover that at cost in the last year of the project in the terminal cash flow. So now, given this information, Our initial outlay would consist of the cost of the equipment, which was, what, 2 mil? And since this is our initial cash outlay, we're talking about the cash flow that occurs today at time zero if they accept the project. And they would have a working capital investment for the additional inventories of 50,000. If they buy more inventories, the cash, of course, is going out of the company. So their initial cash outlay would be $2,050,000. That would be their cash flow for time zero if they accept the project. The boy, the annual cash operating flows which would be for 2 years, since it's going to be a 2-year project. Think of this as cash profit. We want to take everything that lands on the income statement, but express it in after-tax form. And one thing that lands on the income statement will be sales. And after taxes, sales each year would be 3 million. But we multiply it by 1 minus the tax rate to get it in after-tax form. So that would be cash flows from sales after taxes of 1,800,000. We would also have incremental cash operating costs. And again, we want to express this after tax. Their annual cash operating costs will be $1 million, but that's tax deductible. That reduces their tax bill. So after the tax savings, that works out to cash operating costs of $600,000. Any of you have any questions at this point? And then the final item we'll have will be the depreciation tax savings. We're going to depreciate this equipment, and depreciation is an expense, but it's not a cash expense. But depreciation expense lets us lower our taxable income, so we save in taxes. In the first year, our depreciation expense will be the cost of the equipment, times our allowed depreciation, which is 33.33%. That part of it is actually our depreciation in year one, but it's a non-cash expense. Whatever our depreciation is, we get to lower our taxable income by that much. So we multiply it by the tax rate to figure out what our tax savings would be. In year one, that would be tax savings of 266,640. And that's an inflow because it's a tax savings. In year two, everything is the same except the depreciation percentage is bigger. This would give us our depreciation in year two and multiply it by the tax rate. And the one thing that's changing is this depreciation percentage we're allowed from the table. So 2 mil. I'm getting depreciation tax savings of 355.6. And those are all the items that land on the income statement. So if we total them up, we get operating cash flow in the first year. I'm getting 1,466,640. And in year two, I'm getting 1,555,600. Got some check figures. Whoa. Hit them. Did anybody get different figures? Do you follow me? Do you have questions on this? All right. So we go to our last segment, the terminal cash flow. 2 years from now, when they shut down this project, they're going to sell off the equipment. They'll have to settle up with taxes on it with the government, assuming they sell it at something other than book value. And anything they've invested in additional inventories to carry for those 2 years, they think they can recover at cost. They'll sell off the inventories. So how about that? I found a blank one. So in year two, we've got a terminal cash flow. And think of that, since this is a 2-year project, that's an extra cash flow in year two. And what we would get, I guess we could do the tax part first. Anytime a company sells a depreciable asset, whoa. All right, we'll go back. Uh-oh. Great. Give me 1 second, guys. I'm trying to pull up something. Nope. Oh, there it is. All right. It behaved this time. So our terminal cash flow, which would be like an extra cash flow in year 2. We need to look at the book value of the equipment. And the book value of the equipment can be found by taking, like they taught you in accounting, original cost minus depreciation taken. Or you could also just calculate untaken depreciation, which often is the shorter way with these MACRS schedules. The untaken depreciation. After 2 years, we'll have taken year 1 and year 2 depreciation. We will have not taken year 3 or year 4 depreciation on this $2 million equipment. So the book value would be I'm getting 444,400. And I believe that produces a taxable gain because we think we can sell it for 500,000, which is a little bit above the book value. And on that gain above book value, we'd have to pay tax. Our tax rate is 40%. And we're looking at a gain, taxable gain of 55.6. And in a 40% bracket, that's 20,240, sorry. 22,240 in taxes. So our salvage value after tax, we think we'll sell it for 500,000, have to give up a little over 22,000 of that in taxes. And that leaves us with 477,760 after tax. So for our terminal cash flow, we look at our salvage value after taxes, and that would be an inflow. And we also expect to recover that initial inventory investment, which was 50,000. So when we sell off the extra inventories at the end, that gives us, I'm getting a terminal cash flow of 527,760. So the total cash flows for the project would be the initial outlay at time zero, which was $2,050,000. In years 1 and 2, we would have our operating cash flows, cash profit in year 1, 1,466,640. And in year 2, 1,555,600. But in addition to our cash profit from the second year, in the second year, at the end of the second year, we'd also have that terminal cash flow, 527,760, for a total cash flow. Guys, I'm going to play with this just for grins. Let me try something. It worked. No. The total cash flow in the second year of 2,083,360 looks like, on the surface, it looks like a really good project. I didn't ask you to end the problem, but what if we're now given that the WACC for this problem, for this project is 20%? What would be our NPV? What would be our IRR? And using your calculators, if you used a BA2 plus, you would clear out all the old values. Then it would prompt you for the cash flow at time zero, which you would make negative. Then it would prompt you for the cash flow at time 1, which would be 1,466,640. And it would ask you then, how many times in a row does this occur? Well, once. And the default is once. So we hit the down arrow again. Then the cash flow for year 2. That gets all the cash flows in the project. You can hit NPV. It prompts you for the cost of capital. Let's see what we get. I'm getting an NPV of plus 619,978. If down here we simply hit IRR and compute, it would also give us the IRR. which is really high, 42.7%. The NPV would tell us to accept because it's greater than 0. The IRR would tell us to accept. Of course, they're always in agreement. But it would tell us to accept because the IRR of 42.7% is greater than the WACC of 20%.
Mr. Could,
Yes, ma'am.
when we are doing the IRR on the calculator, after like pressing IRR, do we have to press the, the arrow and then CPT?
If you have entered that in and calculated the NPV, do you have a BA2 plus?
Yes.
You can simply hit IRR and compute.
Okay. Got it.
Any other questions? All right. Well, we've worked all the problems in the slides, and I'll save some book problems and other review for Wednesday. For now, if I can get to it. Guys, I'll tell you what, how can I put this? The Microsoft is misbehaving, but I can get around that. Can you see this? Okay, cool. We've gone through this chapter on how to come up with project cash flows, and it's time to reflect on certain things. You know, our sales are merely forecasts. They're not certain at all. No company can forecast its sales for the coming year and the year after that with a high degree of accuracy. It depends on the industry. In some industries, sales are much more uncertain, but there is uncertainty no matter what. If our forecast is off, for any of those items, that makes our analysis inaccurate. My point is you have to be mindful that when you calculate the NPV for a project, you're using forecasted sales, forecasted operating costs, and there is uncertainty to that. For instance, for this project that we just calculated, we forecasted sales of 3 million. We came up with a big positive NPV. What if sales turn out to be a lot lower? Then the NPV will be lower. If somebody comes up with an idea for a project, should they be in charge of its analysis? If you're working for a company and you come up with an idea for a new product, should they put you in charge of analyzing whether they should build a factory and make the product. Why or why not? Would you be objective about it if it was your idea? No. So should the person who submitted the project proposal be in charge of its analysis? No. They'll be biased. Typically, the person put in charge won't look at it objectively. They'll tend to look more rosy toward the forecasted sales and so on. In our project analysis for our annual operating cash flows, was our focus book profit or cash profit? Go back to an earlier slide where I showed you an alternative way to come up with operating cash flow. And if you recall, instead of taking each item that lands on the income statement in after-tax form, which is the shorter way, it's the way we've been doing it, you could build an income statement. Net income was book profit. Did we stop there and call that cash flow? No. We added back depreciation to get a measure of cash profit. So was our focus on book profit or cash profit? Our focus was on cash profit, not book profit. You can't reinvest book profit. You know, when I became a chartered financial analyst, one of the first things I learned is we had to undo everything the accounting people had done to the financial statements, convert them back to a cash basis. That's how you would analyze things, because cash is all that you can reinvest. Were our cash flows before or after taxes? Or another way to say that, did we ignore taxes or did we consider taxes? We did.
We considered them.
We considered taxes, didn't we? Another way to say that, when we say that our cash flows are after taxes, that means we built the effective taxes in. We considered taxes. In all of our problems, and in any problem you have on a test, the only non-cash expense you need to worry about is depreciation. But you should be aware there are other non-cash expenses. Yes, usually depreciation is the big one. In fact, usually if you look at financial statements, they don't have a line labeled depreciation. They have a line labeled depreciation and amortization. Another non-cash expense is amortization. We didn't get into this in this course, but there are certain expenses, cash expenses, that companies amortize. It's like depreciating. For instance, if a company sells bonds at below their face value, if what they get from the sale of bonds is less than face value, they're allowed to amortize that discount over the life of the bonds. And another type of non-cash expense is called depletion. Depletion expense. Companies that operate in mineral resources industries are allowed to take what's called depletion expense. Let's say you've got a coal mining company. They extract coal from the ground. Once they have extracted coal from the ground, there's less coal left in the ground. So they're, in a sense, allowed to depreciate the ground. That's what depletion expense is. But depletion expense would only apply to companies that involve drilling for mineral rights, oil exploration companies, coal mining companies, and the like. But I did want you to know, normally in any problem where we would be adding back depreciation expense, we'd actually add the total of these three. But you won't face that in any of your problems. Should financing costs, such as the interest rate on debt or dividend payments, should they be considered in our project cash flows, specifically our operating cash flows? If you'll notice, if we go back to that one method I showed you, where you develop an income statement to get the operating cash flow, did we deduct interest expense or dividend payments? No. Should we have? No. So where does financing costs come in? How do we account for financing costs? Financing costs are reflected or captured or accounted for, whatever term suits you, in the WACC. Once we get the project cash flows to find the net present value, we discount the cash flows using the WACC. And if you recall, for instance, the WACC would be the after-tax interest rate on debt and the stockholders' required rate of return. Those are factored in. That's where we take into account the cost of debt. This is where we would take any dividends into account if we use the dividend model. So the question is, did we mess up? Was it an oversight to not deduct interest expense and dividend payments to get to our operating cash flows? No. Financing costs are captured in the WACC. So we generate the cash flows for a project, then we discount them at the WACC. That's where we take into account financing costs. If we had we deducted interest expense to get to our operating cash flows and then discounted them with a WACC, we'd be counting it twice. We'd be counting the interest expense twice. We don't want to do that. One other thing. I say one other thing. No, it's not the last thing. Do you guys recall that for the very first project, we had, there we go. We had a marketing survey. This was slide 8 in your slides. The company conducted a marketing survey and it cost $10,000. And it was already expensed for tax purposes. Do you recall us including that anywhere in our analysis? I don't. Here's 10,000, but that was working capital. That was not the survey. When we came up with our operating cash flows, nowhere in there did we consider the cost of the marketing survey. So I raised the same question. Did we mess up? Forget about it? Overlook it? No. Our definition of an incremental cash flow is the cash flow for the whole company if it accepts the project minus what that cash flow would be for the whole company if they reject the project. So here's the question. If they accept the project, what have we spent on that marketing survey? Well, we've spent 10,000. If we reject the project, what have we spent on the marketing survey? 10,000. How does that all net out? Zip. The marketing survey cost is not an incremental cash flow. We've incurred it whether we accept the project or turn it down. So it's not an incremental cash flow. Whoa. Or there's another name for this type of cash flow. It's called a sunk cost. It's spent whether the project is accepted or not. And what are we supposed to do with sunk costs? We omit lousy writing. We omit some costs from our analysis. Sorry about the psychedelic color here. I don't have any other good choices. We're supposed to omit them because they're not incremental cash flows. Let's say you're making $70,000 a year. You think you can do better. So you prepare this elaborate video where you're sitting very executive-like on a stool in a three-piece suit or something like that. It zooms in on you, it fades out, then it fades in your credentials. It cost you $3,000 to make the video. You send it out to other companies. You're making $70,000. Another company offers you $72,000. And otherwise, the job would be very much like the one you're in. Do you take the $72,000 offer? What do you think? You would. What about the $3,000 you spent on the video? You've spent it whether you stay in your current job or take the new one. It should not be part of your analysis. It is a sunk cost. All right. Should opportunity costs be included in the analysis? Let's assume that this the loose project, we have another piece of information. It would be located on land. The company, loose company, can sell now for $40,000 after taxes. This thing is driving me nuts. Where were we? There. That's not where we were. There. I'm having to drop down because I ran out of room. If used for the project, the land would be sold 2 years later for, I don't know, $45,000 after taxes. How do you incorporate this into your analysis? Well, by definition, an incremental cash flow is the cash flow for the company if they accept it, the project, less what they would get if they reject the project. This time I'm showing it in sort of vertical form. And that is an incremental cash flow. So if they accept the project, would they sell the land today? No. Today, they would not sell the land. What if they turn the project down? When would they sell the land? Today, for 40,000. So it equals zero. We take the cash flows with the project. For the land right now, that'd be zero minus what they would have been without the project. That works out to a negative 40,000. And then 2 years from now, had they accepted the project, they'd sell the land for 45. And of course, without the project, you can't sell it twice. You would have sold it at the start. So we actually should show the cash flows for the land as an outflow at times zero of 40 and an inflow of 45 2 years from now. What do you call this negative 40 that we're giving up by accepting the project? It's called an opportunity cost. It's the cash flow we give up if we accept the project. In this case, we'd be giving up the chance to sell the land now. Should opportunity costs be included in your analysis? Yes. You should include opportunity costs. If by accepting the project, you give up some cash flows, it should be reflected. Okay, we're nearly to the end. Yay, nearly there. What does, I don't know. What does Apple need to take into account when they come up with a new iPhone and they project its sales? What they need to take into account is how many of those customers would have bought one of their existing iPhone models. To a certain extent, the new iPhone will cannibalize the sales of their other iPhones. So what should they do in their analysis? They should only show the difference in sales for the whole company. And that would be the sales of the new iPhone less the lost sales of existing iPhones. A classic example of this was Ford. Ford came up with a huge passenger vehicle. I think they call it the Excursion. really big vehicle. And in forecasting its sales, they didn't fully take into account how many of the customers that would have bought their other big vehicles bought the Excursion. In other words, they looked at the Excursion sales, but they underestimated how many of those customers would have bought their, what was it, Expeditions, and I forget the name of the other big passenger vehicle, but the key point is externalities, how the sales of your new product affect the sales of your other products. It needs to be taken into account. Sometimes externalities are not negative. If you've got a chain of shops that sell sporting goods, tennis rackets, baseball bats, gloves, and they add a line of clothing that goes with that, you know, the kind of stuff you wear on tennis courts and basketball courts, that might actually enhance the sales of their equipment. People that come in to look at clothing might buy some of their equipment. People that come in to look at equipment might buy some of their clothing. Of course, that's the whole principle that makes Walmart fly. The whole idea is you have everything there. So somebody who comes in to grab a carton of milk also walks out with a sofa or something. I don't know. Should management options be considered in the analysis? Management options such as what? Well, we had a project earlier that was a 3 or 4 year project. One of the options management I consider is abandonment. Think of it as abandoning the project early. We didn't do this in any of our problems, but there are a lot of entrepreneurs that create a business hoping to attract offers from bigger companies. They may plan out a technology company that they'll, and then on the paper, they may plan to operate it for 5 years, but they also hope it will attract offers much sooner than that from bigger technology companies. And that possibility should be included in the analysis. I guess abandonment is the most common type of management option. Finally, should our project cash flows be expressed on a real basis, which means they ignore the effects of inflation? Or should they be expressed on a nominal basis, which means they include inflation? You tell me. Look back at our, here we go. That very first project we looked at. If we show sales to be the same dollar amount every year, does it look like we considered inflation? Not really. Or for that matter, if we think the cost of labor and materials will be the same year after year, did we consider inflation? And the answer is no, we didn't. And the next question is, should we have? And actually, we should have. If these sales and operating costs reflected inflation, we would expect them to be higher each year. Sales, like with a little bit of inflation, sales in the second year might have been 80,000. In the next year, depending on how much inflation, 84,000. They'd get bigger each year. And for that matter, the cash operating costs would get bigger each year. We'd expect the cost of labor and materials to go up over time. So why didn't I include it when I introduced this whole concept to you? It would have been way too messy. You would have been buried in detail and missed the whole point. So I purposely committed the mistake of ignoring inflation, but I should have included it. Should the project cash flows be expressed on a real basis or a nominal basis? That is, ignore inflation or consider it? And the answer is, it should have reflected inflation. Why? Well, for one thing, depreciation can't be inflated, and yet the other figures will, so you get a mix of real and nominal data. But also the WACC is developed on a nominal basis. When lenders give you an interest rate on debt, let's say they quote you an interest rate of 9%, I promise you, part of what they build into that interest rate is compensation for loss in purchasing power. You're getting money from them now. You're going to pay them back in later years. And with inflation, that money won't buy as much. So lenders in their interest rate build in an inflation premium. Stockholders do the same. In fact, something I haven't pushed is that the primary thing that causes interest rates to go up and down is investors change their minds about what they think future inflation will be. If we get up today and 5-year interest rates go up, that's because the market in consensus has decided that 5-year inflation will be higher. So lenders need to be compensated with a higher return. So to recap very quickly, is the accuracy of our measures, our NPV, our IRR, and so on, does that depend on the accuracy of our sales estimates? You bet. You've heard the phrase GIGO, right? Garbage in, garbage out. The usefulness of our NPV and IRR measures all depend on how good our sales and cost forecasts are. Should the person who comes up with the idea for a project be put in charge of it? No, they'll be personally biased. It's their baby. Did we focus in our analysis on book profit or cash profit? We focused on cash profit. That operating cash flow measure, that's a measure of cash profit. Did we consider taxes in our analysis? You bet. So our cash flows were after tax. Is depreciation the only possible non-cash expense? No, there are other kinds, amortization and depletion. But for our test, for problems, you only need to worry about depreciation. Should financing costs like interest expense and dividend payments, should we have deducted those to come up with our operating cash flow? And the answer is no. Financing costs are captured in the WACC. That's where we take the interest rate on debt and dividend payments into account. Should that cost for the marketing survey have been deducted? No, it was a sunk cost, which means it's not an incremental cash flow. And we only include incremental cash flows in our analysis. Should opportunity costs, foregone profits or sales, should they be considered in the analysis? Yes. We didn't have any in the information I gave you, but opportunity costs should be considered. If you're thinking about starting a small business and you're going to use your truck for the business, you should consider what you could have sold the truck for now for cash. You're giving up that opportunity if you go into the business. Should the effects of our product sales, the effects of those sales on other product sales for our company be considered? Yeah. We didn't have that in our problem. In fact, I had a broad sweeping statement that said that the sales and services from this project will not affect the sales of any other products or services of the company. Had that been the case, we should have accounted for that. Should management options, such as abandoning the project before the planned life, be considered? You bet. And should our project cash flows reflect inflation, that is, be on a nominal basis? Yes. Any questions before we call it a day?
Dr. Cote, I have a question.
Fire away.
So since we're combining the last two tests into one big test, I'm kind of overwhelmed with the amount of information that's on this test. In my opinion, if any time we were allowed our own memory aid, it would be now. So why are we not allowed that option this time?
Haley, I can't disclose that to you. I'll simply bury it in this phrase. You're not allowed your own memory aid to maintain the integrity of the test.
Okay.
Well, look at it this way. That memory aid I gave you has quite a bit of information on it.
Okay.
It's certainly useful for the problems on the exam. And the bulk of the exam is problems.
Okay.
How many questions is the exam?
I don't remember. I want to say maybe 16, 17 questions, and then another 15 or 16 problems. But of course, the problems are worth more points than the questions. Point-wise, roughly, a third of the exam is questions, 2/3 is problems. And I would like to have broken that into 2 exams, given you one, a couple of weeks ago.
Yeah,
School would
hi
not
dog.
pay.
Hello dog.
The school would not pay
Hello dog.
for the proctoring. Enoch, do you have a question?
Yes,
Far
yes
away.
dog. Well, it's not a question, but I've really had a very very bad network today, and look, I practically didn't see anything you wrote today, so it's just like I've just been just listening to you like that, and I want to say if it's possible, like I'll get what you wrote, like the way you answer the questions. If I can get it, I'll try to fix this thing. I'm sure by Wednesday. If not, then it means that I will have to come back to campus and maybe write there.
Okay, Enoch, I'm not sure what you're asking me. You know what?
Yes, dog. Yeah, my internet has
How?
been really bad, very very bad.
Your connection.
It's been extreme.
Yeah.
Yeah, extremely.
Is there another location, safe location with a better internet connection where you could take your final exam?
Yeah, so I'll try and work out something and see if there's another better
Just
location where
don't
maybe I
put
can
your,
get some Wi-Fi somewhere. But
don't
for,
put
yeah,
yourself
but for today, what? Okay.
okay. All right. I have
Sorry, I didn't hear
something,
that.
one more thing to say. Okay? Haley, are
No.
you still there?
Uh-huh.
Yes, sir.
How about I let
Yeah,
you
I'm here.
how about I let you put your own notes on that memory aid I sent to you?
That would be very much appreciated.
Let's do it.
Thank you.
You may put any notes you want on the 4 pages of formulas and whatever that I sent to you, and use that for the
Yes,
test.
sir. Thank you.
Okay. Anything else, guys? I do not have a script for Wednesday. I'm going to simply answer questions, work problems, anything you bring up. But I don't have anything laid out to cover. We have finished chapter 12. So if you want me to work problems out of the book for you, that's fine. Oh, and one other little thing. I know we're running over. This will be quick. In all our problems are, here we go. You know, our depreciation tables look like this. Just bear with me for a second. That's what you've been seeing for 3-year property. Note, it's possible on the test I may have used simpler figures. If this is what's provided in a problem on the test, then use it. Do you follow what I'm saying?
Yes, sir. Just use what the figures and stuff that you've given us for the problem.
Exactly, exactly. Okay. Stay safe. And if you have problems you want me to work or people you want me to see, and Hampton. I love that. Y'all take care. I'll see you Wednesday. Bye-bye.